This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
Well, the good news is if you're at the point where you're interested in looking up YouTube and podcast videos about retirement, you are of a certain age and the maturity levels have escalated absolutely zero, ladies and gentlemen. So you're going to understand what I mean.
That says a lot about humanity or Americans or whatever you want to say.
Listen, you thought you were going for us. You thought you were done with the "I'm not stupid, you're stupid" conversation. Oh no, ladies and gentlemen, you smart investor, you might be the dumb money.
Oh,
let's dive in.
Oh, it hurts so good.
Let's dive in. This is Jon Hicks, founder of J. Hagan Capital. I'm Heather Branch here asking Jon about things like expressions that I don't think are very kind. And also what we're going to unpack in this story here is they might also be incorrect. So Wall Street apparently has a nickname for us everyday investors. They're calling us, quote, the dumb money.
Sure.
Okay, so the assumption is that regular people, you and me, we tend to panic, we chase trends, we make emotional decisions, while the professionals, they're over here being all cool, calm, disciplined, and collected.
That's right.
However.
Well, of course, Wall Street, by its very nature, by calling us dumb money, implies what? That they are what?
So smart. They're the smarties. They're the smart money.
See?
However.
On one side, it's a compliment. On the other side, it's a snide remark.
It's coming back around. Because some analysts are now saying, hang on, individual investors have been surprisingly resilient during recent market sell-offs. So Robinhood's Steve Quirk was telling CNBC how we, the dumb money, we're the ones that stepped in to buy when others were selling. This is Steve Quirk.
They're actually very savvy. They bailed out the market during COVID and they bailed it out again during the tariffs. Like they were aggressive buyers.
I wish I had one of those little sound effects, a little cling.
Wouldn't it be great to have in the background?
Cling.
Yeah. I love the fact that it's very ominous. It's like, and they bailed us out and they'll bail us out again. Whatever it says. Wall Street is called retail investors, which is all of us, right? By the way, called us dumb money since the 80s. Okay. It's not new. Even when you go back and you think about Gordon Gekko from the movie Wall Street with Charlie Sheen and Michael Douglas, all of that, the concept is that insider information, institutions, they had the power, they had the resources, they were the smart ones.
Isn't insider trading, is that illegal?
Well,
dumb
it just depends on who you're asking. Okay. Nancy Pelosi doesn't seem to have a problem with that. And then half of the Democrats
that's not even
in Congress, this is not a joke, this is a very honest statement. We got to put facts out there. They voted against allowing congressional people to not be allowed to do it. I think that's nuts.
Have you found, do you follow the social media accounts that they literally talk about? They have based on online financial trading accounts based on politicians trading, and you can follow it. And it's fascinating to watch.
I think it's amazing. Yeah. I think it's unbelievable. Yeah. So before they're about to do a vote on should they do one thing or the next, they basically, it's kind of like the prediction markets, right? And I think that poly markets and those prediction markets, those could be really troublesome in the long run, betting and speculating on what may happen next. Not to say that there's not money in it, but I don't know that it's a positive thing because it causes people to do immoral or inappropriate things. But having said that, when you look at it, Wall Street is called retail investors dumb for a long time. And often because we weren't educated, often because we were ignorant on how markets move. Cycles are one of the most simplistic things in all of markets since the dawn of time. You can go back to Plato and Aristotle, and they would talk about how markets will ebb and flow. If you learn history and talk about the tulip market in Holland and in the Dutch lands and in the Netherlands, tulips were going for more than like a Rolls Royce today during some periods of time. $600,000 and $700,000 of the equivalent money back there for tulips.
The tulip
guys,
trade,
I'm talking about the flower.
I'm
talking about the flower.
That's actually,
which lasts for 5 seconds?
We get the term futures from the tulip market like hundreds of years ago.
Isn't that crazy? So when you think about all those things, by the way, past and history, that's where all the modern things come from. We have to know history in order to make certain that we either harness it or we're not doomed to repeat it. So when you think about dumb money, interestingly enough, there was a study that was recently done, and it actually was using Citadel's research. So even though Steve Quirk So even though Captain Kirk there is the one that gave us that information, amazingly, what is it?
Quirk, Quirk. He's quirky. That's Steve Quirk.
Oh, he's quirky. All right. So, but the information came from Citadel, which is Ken Griffin. So Ken Griffin is probably one of the most genius financial minds there is. He could easily call almost everyone dumb money. But the amazing thing is the research has suggested that the retail investor, when they buy dips, they actually have made more money than most institutions have in the last period of time, whatever that period of time is, 6 months, 9 months, the last year. And here's my point. That is often very true in an upward moving market, right? When markets generally move up and you buy a dip, you're technically buying a little bit on sales, like going to the TJ Maxx clearance area and it's an extra 15 or 20% off. You buy it that day. And then when it's off clearance, then it's more regular price. But the problem is that only works in an upward moving market. If you take a look at where valuations are today, and this is one of those things that we talk about all the time on the TV programs that we do, and obviously here on the podcasts and so forth, but where the markets are valued is a little expensive. It doesn't mean the market goes down from here. But what it does mean is that there will probably be a time when the dip is going to last a little bit longer. And the question's going to be, and the question for all of us is, not dumb money. Let's don't use that moniker. Let's talk about what happens then. Do we have the resolve, the institutional fortitude, the gut check to keep buying as it deteriorates? Because it's been a while, guys. It has been a while since the markets went down and it felt that way and stayed that way for a while. 2022 was probably the most recent period where not only did stocks fall, so buying the dip took a whole year of just getting beat up, but bonds fell too. So if you were trying to be smart and time the market in a smart way, right, to buy the dips and bonds, you were also getting obliterated. So 2022 is the last time. That's almost been 4 years. 4 years since we've had that just brutal punch in the mouth, that Mike Tyson punch that can sometimes knock people out. So the question to ask ourselves is, have dumb money people, basically us retail investors, have we figured things out? Are we just in a market that allows us to not look as stupid, right? That's what it boils down to, right? So here's what I would say. Buy the dips with your money that you can afford to lose. Do not use your grocery money, right? So when it comes down to dips, Heather, here's the one thing I want to express to everyone. When it comes to buying dips, there's a difference between buying a dip in the market and buying French onion dip at the grocery. If this is money you need to buy French onion dip so you can eat in your home that week or month, don't buy the dips with that. We're talking about money that you're not going to need for at least 5 years. 5 years. Because when you truly do buy a dip, what we're expecting, at least at some point in time, is a prolonged downturn. And 5 years is often the time it takes for a market to cycle all the way down, finally be priced right, to then start moving back up to where it was before. Guys, we don't see enough of these real numbers. But you have to know history in order to make sure that we don't repeat the negative parts. 5 years. Put my hand up. 5 years is the average time for a full down cycle to accomplish before a full up comes on. That is where we want to look at. So I don't know that dumb money, quote unquote, or retail investors have figured it out. Now, what I remember back in the day is that whenever the person in front of you in the Walgreens line or CVS line or whatever line you're in, whenever that person, maybe a little old lady, and she's talking about cryptocurrency or Bitcoin or what bonds are going to do, or Amazon or Nvidia or whatever that stock is, if they're talking about it, the money's already been made. And we don't have to look very far to realize and look back at, at Bitcoin at one point being over $100,000. Now it's in the 50s and 60s, whatever it is. The point is maybe the money's been made on that. No different in the market. People are buying the dips thinking they're genius. Just make sure that we're not using money we can't afford to lose. That's the bigger part about that story.
Okay. All right. So for investors that are in retirement, that are near retirement, what they can or cannot afford, it's a very different ballgame for people in this area. And everything that you just said, it all sounds very interesting, but it also sounds tricky for somebody who might have been a successful DIY investor at their career. It's like, this is a gray area. This is a sensitive space that we're entering into.
Well, making money is very different than holding on to it in the long run. So the greatest thing that any of us can do, right? It doesn't matter what our intellectual acumen is when it comes to business or investing or any of that kind of stuff. The question is, what monies do we have that we have to produce an income for us to keep living, right? To get to retirement or to stay retired. That's the income stream that we don't want to mess with. Then we hopefully have the rest of the money. And think about it like buckets. The easiest way to think about this is buckets.
Okay.
Everyone should essentially have 3 buckets of money that they're thinking about any given day. The first bucket is the now money, the money that we're going to need this year. We're going to need to spend, let's say $80,000 this year. Great. If we have $60,000 of income, then that means we need to come up with $20,000 more dollars so that we can live that year, that $80,000 we need. Okay. So whatever creates that $80,000 is what we have to sustain life. That's bucket number 1. The middle bucket is the bucket that creates all that income, right? So this used to be when someone talked about, well, I'm going to, get a good quality annuity, or I'm going to have a pension, or I'm going to have Social Security, or I'm going to have CDs that are going to pay interest, or I'm going to have bonds that pay this interest. Those types of things would be in that middle bucket that create that income for us to spend every year. That's in that first bucket. All of it creates the income factory that then feeds into that bucket so we can spend it every year, right? And then the third bucket is the growth bucket. This is money that we don't expect to need. Get this, for 10, 15, 20 years. Basically money that we never really expect to have to use until inflation either takes off so much or we live to be into our 90s or 100s and we need something for longevity. That third bucket is really the only bucket that we should be taking any form of real risk with. And if you don't know the math, how much money do you need to have in that income producing bucket so you can live every day? If you don't know that math, guys, you probably shouldn't risk anything until you get that math done.
Okay.
That's what we have to do.
Yeah.
And the amount of money in that growth bucket, you can take as much or as little risk as you want. That's based on your personal appetite for risk. But most people, as we get a little bit older, they don't need quite as much risk in that bucket. Now, does that mean that you don't own NVIDIA or Apple or Amazon? No, you should probably own a good portion of those things, but only in that growth bucket. The money that we can afford to go down and stay there for even a while, 3, 4, 5 years before it finally turns back around. Simple elegance, simplistic elegance is what we call the 3-bucket approach. Buckets have been talked about for years and years and years, not only in books, but on the internet. But the truth is, if you get it right, the reason it's simple elegance is because it is simple, but it fits the retirement plan so well when you get it right. That is mathematical, and that's what makes long-term retirements successful.
All right, you get your buckets, get your dumb money.
Get your dumb money buckets.
Get your dumb money and get your buckets and get over here and let's start figuring out where to put what and which bucket does it go to.
Absolutely.
We joke, but we do have a good time here and helping folks figure out the buckets and their dumb money. It's actually what Jon lives for. He thrives on it. So if you've got questions about all of these things and how your dumb money does matter and does apply in your retirement, reach out to us. You can start the conversation with Jon and his team at J. Hagan Capital. Just go to our website. It's retirementsolutionshow.com. We also have links posted right here on the show notes.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 188279094.